Good morning, everybody. Stocks of the week here, Kirk Spano. And today I am going to give you my top 10 dividend stocks in rank order. And there's a bit of a surprise because it's a bit more than 10 stocks. So I just want to go through a couple things first. First off, there are 3 reasons to buy dividend stocks, and a high yield is not one of those reasons. Dividend investing is about balance sheet quality, asset valuations, and underlying growth. The actual dividend yield is secondary, and folks who prioritize the dividend yield above these 3 other factors tend to get hurt. So ultimately, all investing is about relative performance. So you only want to take single stock risk on stocks that can significantly outperform the S&P 500. Otherwise, you might as well buy an index. The stock market correction is a perfect time. Any stock market correction is a perfect time to upgrade your portfolio. These 18 stocks can help you. Why 18? You'll find out in a minute. So this Buffett guy says that time is the friend of a wonderful company and the enemy of the mediocre. And I say the enemy, not the enemy, the enemy, because mediocre stocks proliferate the stock market. Ultimately, I believe that about 80% of stocks just aren't investable on their own. Now, you're going to get exposure to these stocks because you'll own some ETFs or mutual funds, but you should never really buy the stocks individually. Just let them blend in with the funds so that they can't hurt you very much. And if you're picking out good funds, we'll say the S&P 500 is the ultimate average fund, because that's what it is. It's by definition average. Then what you are looking for are things that can be the S&P 500. And if you own most of the S&P 500, you'll never beat the S&P 500. So you need to try to find the 1 in 5 stocks, give or take, that can beat the index without taking a lot of extra risk. And because of high correlation in the markets, it's hard to figure that out sometimes. Because when the stock market's going up, pretty much everything goes up together. And we saw that prior to about December of last year. From September of 2020 until about November of 2021, we saw extremely high correlation as stocks went up in the large cap space. Of course, we also saw that small caps didn't participate once the initial rebound rally was completed by about January of 2021. But during those 14 months where the large caps went up in a highly correlated fashion, what we saw is that your advanced decline line got to the point where it was something like 90% of all stocks were going up at the same time. You tell me, does it make sense that 90% of all the companies were doing just as well as each other, that their stocks should be performing about the same? No, that doesn't make any sense. The stock market from the start of QE infinity in April of 2020 through near the end of last year was an anomaly. That spike in the small caps that disappeared earlier and the large caps, which is disappearing now, were unusual historically. And the people who believed that it would go on forever, either they were lying to you, lying to themselves, or just really weren't that smart. Because we have seen throughout history that when the Fed sprays money, stocks go up, and when the Fed tightens up, stocks go down. Don't fight the Fed. It works over and over and over again. However, there are time lags. Sometimes the Fed does something and the market reacts immediately. Other times, it waits a while. So while the 2 lines on a chart between Federal Reserve easiness or tightness and the stock market don't move exactly in tandem, it tends to be a shadow or an echo. So sometimes, again, the Fed leads, sometimes it trails, but the market either gets a little ahead or falls a little behind, but follows the same path, just not in the same time window. Think of it like driving between your city and another city and somebody else doing it an hour later or 6 hours later or a day later. It's the same path. Might be some different obstacles on the road depending on when you travel, but you're going to end up at about the same place, your city to the other city. You might go to a different address. And that is how the Fed policy and the stock market move together. Not always exactly the same time. Sometimes the road is just a little bit different because of the time of day, but ultimately the Fed and the stock market are tied at the hip. So when you want to invest you need to keep that in mind. The thing that I missed is that I didn't think the Fed back in April of 2020 was going to print enough to overcome what was the worst economic event in history by far, far greater than the Great Depression or anything since stock markets have opened. And it turns out that they overdid it, and they pulled forward crisis money of the future to 2020 and 2021. And in fact, at the very moment we speak, the Fed is actually still printing a little bit of money. QE, that QE infinity that I've talked about, got to be 100 times by now, at least. And I'm just as tired of it as you are. But the reality is that when the global economy shrinks a certain portion, a certain amount, and the central banks and Federal Reserve print more than what came out of the economy, it meant one of two things. Either they expected things to get worse, or they were pulling things forward. Turns out it looks like they were pulling things forward, whether they knew it or not, because ultimately the pandemic is getting into the endemic phase. I have warned that people should be aware that the way viruses work, though, there could be another big problem in the future, because even though 75, 80% of the population is either going to have been vaccinated and or had the virus, you're still going to have 20, 25% of the population. I'm talking Western world. It's worse in other parts of the world, in your emerging markets, for example. But the next stage of the virus, or the stage after that, but at some point soon, next year or two, there's going to be a variant of the virus, and there's a couple identified already, that are much more deadly than what we've seen recently with Delta and Omicron, which I think should be called the Chi variant, because that is actually the order that it was supposed to go in, but we didn't want to offend China. In any case, there's going to be a variant that's very deadly. And even though it'll probably only affect a quarter of the population, give or take, the unvaccinated, it's going to kill a lot of them. And it's looking like 20, 30, maybe even 50% who get it. Imagine if we have a ratio that high, where 1 in 5 people who aren't vaccinated die from it. And then probably another big hunk have permanent conditions. That's going to be a shock to the system. If things keep moving at the pace that they're moving, it could happen this year. In fact, I would guess that it would happen this autumn, and that we'll get 3 or 4 horrific months yet. And that is part of my thesis on why I think 2022 will look a lot like 2018. Originally, I thought 2020 would look a lot like 2018, with the virus and the infinity QE. I think that this year moves in more typical waves. I think that we're seeing a correction now, and we'll get a rebound soon. The Russia-Ukraine thing will go away in due time. We're pricing in an awful lot of disruption there. I'm going to tell you why in a couple minutes, why it's probably not going to matter that much. I already mentioned it the other day. During these next waves down, the one that we're in, and quite possibly another one at the end of the year, you're going to want to upgrade your portfolio. A lot of us already own growth stocks that got beat up over the last year. The next phase of our investing is to really amp up our dividend investing. Now, a lot of people are like, well, why didn't we do that already? And the reason was, over last year, almost everything was overvalued. Now a lot of these are coming back to us, and I would anticipate they continue to come back to us. So I'm going to talk to you about these 18 stocks, tell you how I'm going to use them, and I'm just going to focus on what the market is missing with each one. Because when I pick out stocks, I'm not looking for whole home average. Oh, well, this one looks okay. Kind of like this one. Got a feeling. No, I want to know what the market isn't pricing in. What is the market missing? And luckily for us, 80% of the people who invest don't study the companies they invest in. I have a feeling. I read something about something from somebody. 80% of the people don't do any research at all. So we have an edge, because that's all I do is research. And I research other people's research. Got over 30 subscriptions. You saw me pop up FS Insight, Tom Lee's publication the other day. Luke Groman's Forest for the Trees, Bear Trap Reports. I'm not talking $200 a year services. I'm talking $100 and $200 a month services, $300 a month, $400 a month. Man, I think the one is honestly it's $4.99 a month. I pay a lot of money for one of them. Another one's $250. So when I do sell side research, right? When I do bottom up research myself, just because I think I found something, the screen that I use through Stock Rover alerts me hey, take a look at this. There's something out of the ordinary. And then I do the bottom-up research. Then I flip over to the buy side and I read other people's research, and I'm trying to figure out whose research is the best, who's actually right. And when you go over to Tip Ranks, who I'm supposed to be writing for, but I just don't have time, you take a look at the top analysts, and they aren't institutional imperative types. What is the institutional imperative? Warren Buffett has talked about this. The institutional imperative is that you just want to kind of hide in the crowd, because if everybody's wrong, nobody gets fired. But if you're the only one that's wrong, you get fired. So they hide. They just kind of follow each other. That's why downgrades from analysts generally don't come until well after the stock has gone down. It's very rare that an analyst will tell you, I think this one's overvalued. I think it's going to go down. Or I think there's a problem with their business and I think it's going to go down. Why? Why don't they tell you that? Because then they stand out. And that's why, again, 4 out of 5 analysts suck. They don't actually give you their best work. They don't even try. But guys like me, the 1 in 5 analysts who are trying to give you our best work, trying to give you something that's different than the crowd, because if you just want the crowd, again, by the index, we end up over full cycles crushing the market. And there's anomalies. There's 2 or 3 year periods where we trail because, something weird happened. Fairly certain I'm not dumb, any dumber than I've been told anyway. I have never been more confident that I'm right about things than I am right now. And remember, I publicly published that I thought the stock market would crash in 2000, back in 1999. And I publicly published in 2007, at the same time I was buying people dinner, telling them to sell property if they had it and sell stocks if they had them, because there was going to be a financial crisis. All these things have been tied to demographics and the way the Fed works and the madness of crowds. I believe that 2020 was going to be a bad year. And it was, but not for the reason I thought. And then it got bailed out with bigger bailouts than ever. So the correction that started in January of 2020, everybody missed it because coronavirus took over 2 months later. If you take a look at the charts, the correction in 2020 already had started before I published January 23rd, 2020. I said the coronavirus was going to be the most important story in the world. See if this article is still up. Here's the article. But the stock market had peaked a little bit before that. So it was already starting to head down when coronavirus became known. Then obviously nobody really picked up on coronavirus until late in February. So a whole month. What we have going on now is an unwinding by the Fed. It's not going to unwind nearly as much as people think because inflation is not being caused by the Fed. And you have got to wrap your head around that, because if you believe the Fed is causing this inflation, then you are a muppet. You are just believing a narrative because people are saying it loud enough and often enough. I showed the chart the other day. Inflation is correlated to oil for the most part, and oil has gone up in price. It is still drifting up, and I believe that this whole Russia-Ukraine thing is going to end up being the peak in oil. Why? Because Exxon and Chevron have already announced they're going to add 900,000 barrels of oil a day by this time next year. And there's another few 100,000 from the rest of the producers in America. And it looks like there's going to be an Iran deal. And that will bring at least 1 million barrels of oil to the market per day, probably 2 in due time, maybe 4 down the road, but 1 million barrels per day, probably within 6 months of the agreement being reached, and 2 million within a year or two, because companies like Total have maintained their relationships in Iran. So once oil is being pumped at 2 or 3 or 4 million barrels more per day, which will probably be by next summer of 2023, that is, price oil comes down, supply chains have started to clear up, logistics systems have cleared up. And what do we realize? Slow growth forever is still slow growth forever. And that means you need to be in quality stocks that are going to benefit from the bifurcation of the economy from new economy to old economy. If you're in grandpa stocks, you're going to get crushed. And if you're a grandpa, remember not to panic, because you're the one most likely to do it. Every study shows that it's old guys that panic the most. I'm not going to go into all the psychological reasons why, but they're there, and it repeats over and over and over again. So if you're 50-something, 60-something, 70-something, and you have fear in your heart, make your changes to your portfolio now and have a plan before something scares the shit out of you and you worry that you're not doing the right thing. So better dividend investing is based on what? Balance sheet quality, asset valuations, and underlying growth. Those things will create a dividend yield as management gives back to shareholders. So here's my top 10 stocks. And remember, I consider 3 to 4% of a portfolio to be a full stock position. ETF's a little bit bigger. So you see that the first 4 are grouped together. Why is that? Because Comcast and Paramount, I think you should buy together. Content is king. You've heard that before. Comcast and Paramount have a ton of content. Comcast is NBC Universal. Paramount is the former Viacom. They just changed their name. They have franchises like Star Trek. NBC Universal has the whole run of things, including sports. Paramount has sports as well. We are going to see a lot of consolidation in that space, and we are going to see a couple of these other companies that I'll mention soon probably buy some of these companies, if not both of these. I think both NBC Universal and Paramount are both in play. I think that Apple, Google, Facebook are all likely buyers of these 2 companies. So you have 3 gigantic tech powerhouses with a ton of cash. I guess you throw Microsoft in there too, bidding for the 2 companies that haven't already done deals. One of the companies I'll mention here in a minute is already doing a deal. So the market right now with Comcast and Paramount already down, Paramount down to obnoxious levels, are either buys or almost buys right now. Paramount, you know that I already own it. Comcast, I've been watching it closely. And there will be deals. And the market's missing that. And the market is also missing that a ton of the content that's out there is crap, that people still like well-produced movies and their favorite TV shows. We already saw Amazon buy MGM. We've seen AT&T and Discovery get into a deal. Comcast and Paramount deals are coming. It's almost a certainty. And I bet that the deals have something to do with big tech because they've got the money and the platforms and the customers and the advertising systems to want these piles of content. So what I would do is I would own both Comcast and Paramount, but think of them as one position. And you could add Discovery in there at some point, but that's not a dividend stock right now. Why do I have Blackstone and KKR there? They're private equity firms. Well, with all the interest in energy stocks over the last couple of years, I will tell you, it's not Exxon and Chevron and Pioneer that you really want to own. It's Blackstone and KKR. Why? Does anybody know the answer to that? It's because Blackstone and KKR are vulture investors, and they've been buying all sorts of oil and gas assets from production fields to pipelines for the last 6 or 7 years at rock bottom prices. So the value in energy isn't Exxon or Chevron. And can you squeeze another 20% out of those? It's the assets that Blackstone and KKR have. And by the way, they're taking those profits and pumping them into clean energy. So if you want to play on the energy transition without completely giving up on oil and gas in the short run, Blackstone and KKR are your plays, and they pay pretty darn good dividends. So these are stocks that you can buy in pullbacks. Now, I'm not so sure I want them right now, and I'll have the charts up in here when I publish this for members of Margin of Safety and Fundamental Trends. But given a choice between Exxon and Chevron or Blackstone and KKR, I think you'd be a fool to buy Exxon and Chevron. This is where the value is. Much lower cost basis on assets, no stranded assets. They've put together amazing portfolios. Go look at their website. Some of it's listed at very low prices. And on the idea of energy transition, my favorite utilities are NRG Energy and Algonquin Power. Now, Algonquin has natural gas assets as well, some geothermal. They operate in 2 divisions. And the division that is growing the fastest is the clean energy. So they are also part of this energy transition, and they're doing it internally. Energy is a little further along in the process. Again, utilities with some regulated assets, good dividends, and all you have to do is get them on the corrections. For REITs, there's not really any good ETFs out there. If you take a look at the Vanguard Real Estate Fund or really any real estate ETF out there, none of them beat the S&P 500. And people can talk about it all day long about how great real estate is, but the reality is that in the last decade, pretty much all of the gains have been concentrated in industrial REITs, storage REITs, and some specialty REITs. Your office REITs, your residential REITs, your mall REITs, go right down the list. They've all been highly cyclical, highly influenced by the economy, highly influenced by interest rates, and actually have had pretty high volatility. I always throw out Simon Realty. They're not really any further ahead in the game than they were 20 years ago. They go way up, they go way down. They go way up, they go way down. Now they're rallying on QE Infinity. But if you've been to the malls, you know that the nature of malls have changed. And it's really only the very high-end malls that are doing anything at all. Even those have some limitations and are going to require further and further capital investment. But as supply chains continue to move back to America, which started under Barack Obama, basically, George W. Bush tried to get it set up. Obama followed through. It was a big Trump thing, and now it's a big Biden thing. It's all of them, both parties. Everybody knows that we have to move supply chains back here for security reasons, and because of technology and where the consumers are and where the resources are, it makes sense to come to America because we have consumers, we have resources, we're secure, we have technology, we have a trained workforce. So my favorite in that spot is Stag Industrial. Now, you could further break this out and own 3 or 4 industrial REITs. There's several other good ones out there. I have them on the VSL. You can take a look at those, our watch list. But I like Stag Industrial. I like Vici Properties, a specialty REIT, gambling, basically. Very heavy in Las Vegas, but expanding and tied to maybe the most recession-resistant industry in the world, which is gambling. Gambling just never goes away. When you got a lot of money, you gamble like a sailor. And when you don't have a lot of money, you take what little you have and you try to make it bigger, try to spin it up. Gambling survives, and it's expanding online. Pretty soon, you're going to have gambling everywhere. It's all going to be legal. It'll just be regulated and taxed. It's already started. The process has been going on for years. And Vici does really well because the companies that pay their rent to Vici all are going online. Now, do I worry about so many properties in Las Vegas? No, and here's why. Las Vegas, compared to, say, Phoenix, has done all the right things with mitigating their potential exposure to climate change. And the nature of the valleys is different. Las Vegas has done very well on maintaining their water standing by accumulating water rights. And 6 or 7 years ago, they started going into solar energy. So Las Vegas, I think, is probably one of the few desert towns that are not going to have major problems. So I would be, if I was going to do a pair trade, I'd be long Las Vegas and short Phoenix. The other one is American Tower, which is cell phones. And I like them better than Crown Castle because American Tower has a lot more emerging markets exposure. And they have some investments that they've made from their cash flows that could do very, very well. So Stag Industrial, Vici, and American Tower. And you have to decide, do you want to have 3 or 4% of your money in REITs or 6 to 8% or more? And if it's more than 6 to 8%, you probably add a few more REITs, a couple more industrial REITs, maybe Crown Castle, maybe a storage REIT or 2. I think storage REITs probably continue to do well, but not as well as they have in the past. Here's why. A lot of storage has been built, and there's a record number of housing units coming on the market. One of the reasons that a lot of people have been renting at storage facilities is because they didn't have space at home. So with new homes coming online that the millennials are building and that investors are building, there'll be a little bit less need for storage. So I'm not saying don't own storage REITs, but I will say they're pretty fully valued. I think that the supply-demand equation is slightly moving against them, and I'd just rather have the industrial spaces. A little bit more recession risk, but not much. And a huge secular trend in favor of industrial REITs. So here's the top ones. Pfizer. Been talking about Pfizer for quite a while. I don't think people completely have their head wrapped around, even at this point, the messenger RNA. So the mRNA that Pfizer is involved with has so many applications, and COVID's not going away. We're going to get a shot for COVID every other year, probably, maybe every year, who knows? And especially if there's a more deadly variant, we're going to have to vaccinate for it. And now they're starting to figure out exactly what long COVID comes from, and mRNA might be part of it. So I love the platform that Pfizer has built. Unfortunately, there's a disease that's going to need to be fought for a very long time, and there'll probably be another one. Pfizer has been chopping around for a very long time, years and years and years. I think Pfizer is going to break out the next time the market rallies. I think it'll be one of the best dividend players out there. Why do we want AT&T? Well, the AT&T play is already about halfway through, but the price of the stock still is beaten up. So you can buy AT&T right now. In the next quarter, the deal with Discovery is going to happen, and they will spin off Warner Brothers Discovery, which is going to be one of my top growth stocks. The remaining AT&T will get a cash infusion and a reduction of debt, be focused on fiber and 5G, And there's a couple things that the market is missing. One is that if the ASTS space mobile satellites work, and it seems like they're going to, AT&T could suddenly become a global telecom company. And I believe that at some point, technology will make that happen. And AT&T is an early investor in it. If nothing else, AT&T gets valued more like Verizon, which means that AT&T probably doubles just on that once the spinoff occurs and they have a better balance sheet. I believe that fiber is a growth engine as we do more and more work from home, as we exchange more and more data. I've showed you the stats on that. There's going to be 5 times more data by the end of this decade. You need bigger pipes. AT&T is probably the best positioned on this side of the Atlantic and Pacific to do that. And by the way, you get a great spinoff in Discovery, Warner Brothers Discovery, sometime in the next quarter. It just got approved, by the way. The next stock out there, and if you really wanted to pair up GM with Ford, you could. I'm not, because of the sexy factor. I just think the Ford cars are that cool. So while you have a lot of multi-generational GM buyers, when you compare the Mustang Mach-E and the F-150 Lightning to anything GM's putting out, the Ford cars are just nicer looking. They're prettier. They're sexier cars. They just are. And to the millennials, I think that'll matter. And the way that the millennials have been investing in Ford, I think you can already see it. So between Ford and GM, I just think the millennials are going to like Ford better. And that's a big deal because that's the big wave of money coming into the market as they earn and as they inherit. Ford has already jumped up to be the number 2 EV producer behind Tesla. And I think that Ford's going to pass them by about 2027. And there will be a convergence in the market caps of Tesla and Ford. Maybe that just means that Tesla chops along now for a decade and Ford starts to catch up. You know, one of the things people said about Tesla is that, well, they were going to do all these other things, batteries and solar power. Ford just cut a deal with Sunrun. Can you imagine if Sunrun has a presence in all of the Ford dealerships going forward? Hint, they will soon, just like they have a presence at Costco. So Ford is actually one of my top growth stocks. By the way, they pay a dividend over 2%. They've promised to grow it and buy back shares. What is the market missing about Ford beyond what I just said? Their fourth industrial revolution technology that I've talked about over and over again gives them the opportunity to participate in other businesses, whether they own the business, partner on the business, invest in business, whatever. And then they have real estate that they can pivot to these other opportunities as supply chains move. So you can think of Ford almost like an industrial REIT, because internal combustion engine vehicles take about twice as much floor space as EVs. And by the way, Ford is building a couple of battery plants in a partnership. Everything that Tesla stock did, I don't know that Ford will do, just because it doesn't always happen with the second player. But there will be a big catch up here between Ford and Tesla. Will it be 100%? I don't know. But if I had to make a prediction, I would say that Tesla chops along in a range for many, many years, and Ford closes the gap for many, many years. And that means that Ford probably goes up 5, 6, 7, 800% this decade, maybe 1,000%. It might be a 10-bagger. Certainly from the $5 and $6 a share that some of you bought it at, it's going to be a 10-bagger. For those of you buying it around 20, can you live with 5, 6, 7, 100%? I probably can. The next company is Intel. They kick out a decent dividend. They have a fortress balance sheet. The government just gave them money to help them expand their production of semiconductors in America to protect our supply chains. They're building in Arizona and Ohio. All these fabs will be coming on over the next year to 3 years, and the semiconductor shortage will pretty much be gone at that point. They're going to make a lot of money. Compare them to Taiwan Semiconductor, who was the only company in the space fabricating for other semiconductor companies. Intel's going to make a mountain of cash. The government's helping them do it. Remember our 4-step process. Secular trend, clearly on the side of Intel. Government assistance, clearly on the side of Intel. Fundamentals, they have a fortress balance sheet, and they're growing. Technicals, nobody has bid this stock up yet. If you are a dividend investor, this is a stock you want, because they're going to keep increasing their dividend. They're going to keep buying back shares, and they essentially are debt-free. That is a shareholder yield dream. So while you can run around saying, I'm looking for 7% dividend yield because I need that income. Look, man, Warren Buffett has told you the right way to handle this. Remember this. From a taxation standpoint, you're better off selling a share in a non-qualified account than you are taking the dividend. Long-term capital gains are taxed more favorably. And most people have most of their money in retirement plans anyway that are tax sheltered. So if you trim, not when you need income, but trim when the charts tell you it's a little ahead of itself for the prospect of using it for income later, then you're going to do things right. If you just sell because you say, I need $1,000 this month, I'm going to sell, you're doing it wrong. Sell a little bit ahead of when you need the money when the chart says, hey, this is a good spot to trim. Apple, number 2. And I'm splitting hairs here between Apple and Microsoft. Apple probably has the best franchise on the planet. And while they talk about privacy, and they're trying to brag about privacy by clamping down on Facebook and Google using your data, there's more to it than that, right? That's the propaganda. It's true. They are helping you control your data a little bit more. Most of us don't understand how to do that anyway. What they're really doing is they're consolidating power onto their own platform. That's what they're doing. And with about half of the cell phones in the world, Apple, in the Western Hemisphere for sure, with so many iPhones out there, if they can take some of that revenue from Google and Facebook and give it to themselves, A, nobody's going to care. B, they have a good way of spinning the narrative. And C, how is it ever going to disappear? People who buy apples keep their apples. Why? They're super easy to use. They do everything that you want other than allow you to program it. And you know what? 98% of us could care less about programming our phone. I just want it to work. And I want to take cool pictures. And I want it to not be slow when I'm sitting in a stadium and I'm trying to look up something about that guy that was just batting. That's what Apple does. You could definitely argue that Apple is the number 1 franchise in the world. And I think you'd probably be right. But I'm going to rank Microsoft number 1 on this list. It's just as rich as Apple, has a little 1% dividend like Apple, but they're increasing the dividend pretty fast. Share price just keeps going up. So it doesn't look like it. Apple and Microsoft both buying back a ton of shares. They both have fortress balance sheets. Why do I like Microsoft a little bit better? One word, cloud. Microsoft is making huge headway into the cloud, which we know, again, probably going to increase around 5x this decade with all the satellite data, with all the Internet of Things data. Azure is a big deal. So years ago, when I worried that Microsoft was going to get competition for Microsoft Office and the operating system, some of that competition came, but none of it stuck. Didn't really dent the franchises. Slowed the growth down maybe a fraction. But then they piled on the cloud. And now you have Amazon, Microsoft, and Google dominating the cloud, and then you have a group of smaller players and then a bunch of up-and-comers. And there will be consolidation there probably. But Microsoft and Apple and Intel, holy cow, what a group. You're not going to get a 7% dividend there, but you're going to get higher quality, higher growth, more share buybacks than some of these knucklehead 7 and 8 and 9% high dividend yielders that are looking over the edge every time the economy gets shaky. And I will say, Intel, Apple, and Microsoft, they're all top holdings in QQQ, Apple and Microsoft especially. Intel will become bigger. You could just buy QQQ for your coverage here, or you buy some QQQ and then a little bitty half position maybe in Apple, Microsoft on top. I'm intending to have a full position in Intel because I think there's the most growth available there. So Intel and Ford, huge growth potential. AT&T, the spinoff, and then you get Discovery, and you should hold Discovery for a while. I shouldn't sell it right away. Pfizer, and you get really good diversification with these 18 stocks. And again, you can add a couple more REITs if you want to have a little bit more REITs. I wouldn't go more than 12% total, which would be basically a triple holding. 3 or 4% split roughly evenly between these two, 3 or 4% roughly evenly between these two, 3 or 4% roughly evenly between these two. 3 or 4%, 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 minus potentially exposure in ETFs. But again, I have a double exposure in a double position in AT&T right now because of the deal that's coming. And with Apple and Microsoft, if you had a full position in the stock and then also had QQQ so that it really was a double position, I don't think that should break your heart. I mean, these two, there should almost be a dashed line between them and all the others. Then the honorable mentions, HP, and Seagate. What the market misses about HP, right? Because everybody knows about the ink, right? The renewables, or the consumables. HP has an investment division, and it's a big deal. They are investing in all sorts of up-and-coming technologies. They partner with them a lot like Palantir is partnering with some of their investment companies and customers. So if they help them develop their technology and they get a cut. That's what Palantir is doing with like whatever it was, 15 growth companies. So these companies have cash flow that they can then turn around and invest in companies where they have an edge, pretty valuable. What company that we know that turned out to be pretty big does that? Little company in Omaha called Berkshire Hathaway. They have their own business that generates cash flow. Then they turn around and buy pieces of other businesses, a lot of times by financing those businesses. So a number of the companies that I'm in also invest in other companies. And they're doing mini versions of the Berkshire Hathaway model or the Markle model up in Canada. Seagate operates in a duopoly with Western Digital. Both of those companies are vertically integrated. I like Seagate better balance sheet. I like some of their customers, some of their deals that they've done with, say, Singapore and Norway, right? They do the hard disks to store the data that's in the cloud. It's a big deal. Cloud's growing fast. HP, Seagate are both a little overvalued right now. They're ahead of themselves, so I'm not buying them right now. But there is a spot where we want them. Nutrient, we bought way back when it was, 25, 20? And I said that because of the supply and demand dynamics in fertilizer, which I've been studying ever since I started gardening when I was in college, is important to understand that with climate change, and anybody who's paying attention to climate change knows that it's accelerating. Nutrient is going to be a big deal. They're increasing their dividend. They're buying back shares. They're wiping out that shareholder dream. Stock price is just a little bit high right now. But back when it was 2025, I told you that it was going to probably go up to around 100. And now it's 75. Will it get to 100? Yeah. Will it pull back to 50-ish first? Maybe. We'll see. I think so. So HP, Seagate, Nutrient on the list, not as close as the other ones being buys. All right. This is going to go up open to the public because I don't have the charts in here yet. If there was charts in here, I'd have to put it behind the paywall on YouTube. So all the charts and everything will go in here with my short explanations of what the market is missing and why these are my 18 favorites, why this is where I think you should focus over the rest of this year. And we might add a couple more. Might end up being a top 20. But focus here. And you probably have all the growth stocks you need because we've been accumulating them for a year. So now you're going to want to add this side of the portfolio. Take your time. Understand there's a little bit more of this wave down, then probably a rebound, and then more wave down, then maybe a rebound and another wave down. We'll see. We're not sure what type of correction this is going to morph into. And I think there's something that we don't know yet, which is what does COVID look like in the fall? Again, if I had to guess, I'd say a much more deadly strain. Doesn't affect as many people, but if it's killing a higher percentage, still bad, really bad. And people will get scared. The economy will slow down. And then maybe that $1 trillion that the Fed has sitting on the side finds its way into the stock market. All right. Have a great, great day. Rest of the President's Day. I'm going to make some lunch, and then I'm going to go see my son put on a show in downtown Milwaukee. He is an up-and-coming mentalist and magician, and the kid's actually making money at it. So who knew? All right. Everybody have a great day. This will be out by tomorrow sometime. And then next week, we'll cover the growth stocks. All right. Everybody have a great day.